Right, today we're going to look at return on equity, return on invested capital, and return on assets. We'll go through what they are, how to use them, and how they differ from one another. I'm Lewis, and this is Stock Thesis, where we break down value investing. Subscribe for more of that. Return on invested capital is a measure of whether the business is reinvesting its capital well. It looks at how well a company uses its debt as well as its money invested in it by the stockholders to generate additional income. It can give an idea of how effective the company's current management is in creating value. The formula is net operating profit after tax divided by invested capital. You can work out the net operating profit after tax by taking the earnings before interest and tax and then deducting the tax. This leaves in the interest, and that's because the interest belongs to the bondholders, who incidentally own the debt. And return on invested capital looks at the return from both the debt and the equity perspective. Invested capital is equal to the working capital plus the fixed assets, with the working capital being the current assets minus current liabilities. This is because current liabilities are not a sustainable source of long-term financing and therefore cannot qualify as capital. The fixed assets are physical, like the plant, property and equipment. One of its limitations is it's hard to gauge which investments are generating the return. Different factors such as the inflation, creative accountancy, and even global currency can have an impact on the return on invested capital. Next up, return on assets. Return on assets indicates how well a company is using its asset base to generate earnings. Some industries need less assets, such as more service-based companies, whereas some companies are very asset-heavy, think mining companies. Returns on assets is calculated by taking the net income and then dividing it by the assets, with some calculations subtracting goodwill and intangibles from the asset base. High leverage companies won't affect the outcome of the return on assets, unlike return on equity. This is because assets are equal to the equity and the debt, and therefore the higher debt can cause return on equity to give higher results than the return on assets. In contrast, if a company has no debt, the return on assets and the return on equity would be the same. Again, creative accountancy can influence the return on assets. There may be incentives for companies to overestimate or underestimate its asset base. Another limitation is it could potentially punish a company if it has an excess of cash on its balance sheet. It's also worth bearing in mind companies at different stages of growth might have very different return on assets. Return on equity is a measure of how efficient the company is at generating profits for the shareholders. Bondholders who own the company just want the interest and their principal back, which is the initial amount they lent to the company. Both of these are fixed. Shareholders, on the other hand, are entitled to a greater return should the company make them. This is Buffett's favourite metric. The man himself says, focus on return on equity, not earnings per share. The return on equity formula is as follows: net income divided by shareholders' equity. This shows how many dollars of earnings the business produced for how many dollars of equity it has. Utilities being an example of an industry with lower returns on equity, whereas your Silicon Valley companies being an example of a company with high returns on equity. While higher is usually better, there are some things to be aware of. As previously mentioned, a company with higher debt relative to its equity can have high levels of return on equity, and obviously that is not a good thing. So, for example, if a company has a higher return on equity because it was highly leveraged, and that return on equity started to reduce because the company was paying down debt, that could actually be a positive sign. If this is the case, it will cause there to be a large difference between the company's return on equity and the return on assets. Capping it off, return on invested capital can be used by bondholders and shareholders. It measures how well the management is reinvesting total capital. Return on equity is a measure of how profitable the company is from a shareholder's perspective. Return on assets is a measure of how much assets the company needs to make its earnings. I hope that gives you an idea of how to use these ratios, why, and their limitations. And if you like the video, make sure to give it a like and subscribe. Have a good one. Cheers.